Have you heard the story of these two men? Ronald Reed, the janitor who retired as a millionaire and had $8 million in savings when he died in 2014. He didn't win the lottery or inherit any money. All he had was a high school education and some patience. He simply saved and invested consistently throughout his life and let the miracle of compounding do its wonders. The second man was Richard Froscombe, the well-connected, Harvard-educated Merrill Lynch executive with an MBA, who went broke after retiring in his 40s due to the leveraged lifestyle he led, which he couldn't maintain during the 2008 financial crisis. Morgan Housel, author of The Psychology of Money, tells these two stories to buttress the key lesson in this book, that your behavior with money is oftentimes more important than how intelligent you are. So even if you don't have a degree from Harvard, Yale, Princeton, or Oxbridge, or work on Wall Street or Goldman Sachs, you can become wealthy just by behaving in a sensible way. Morgan Housel aptly puts it in this way: financial success is not a hard science, it's a soft skill where how you behave is more important than what you know. Hello, welcome to Wisdom Inspired Talks. I am Yomi Akinpelu, your wisdom coach, speaker, teacher, and author of several books. Today, I'm reviewing the book, The Psychology of Money by Morgan Housel. So, let's dive right in. Here are 7 lessons from the book, The Psychology of Money. Lesson number 1. Be ready to pay the price. If you want really high returns in the stock market, you have to pay the price. If you have a well-diversified portfolio, you will likely have a reasonable return. But if you want very high returns by investing in individual stocks, then you will have to pay the price for it. A concentrated portfolio brings with it high volatility. This is the price for achieving high returns in the stock market over the long term. If you don't have nerves of steel or the stomach to stay the course when your net worth decreases, say by about 20% in a single week, because 2 of your major stock plummets and report earnings below what the analysts expected, don't aim to maximize your returns, because the higher the returns, the higher the risk and volatility. For example, if 10 years ago you could imagine Netflix as a rising star, and so you invested a sizable percentage of your net worth in the stock at $34 per share in 2011, by 2021 you will be quite rich when the share price rose to $530. However, would you have been able to pay the price for this journey? Because during that period between 2011 and 2021, Netflix had many major downturns. Would you have held onto your stocks when Netflix lost a huge number of customers and stock prices fell 80% from its peak during the ensuing month? Your returns would have been abysmal. You would have felt terrible if you were heavily invested in this stock. Your net worth and sense of security would have hit rock bottom. Would you at the same time think that investing most of your money in Netflix was a good idea? Investing in a single stock for really high returns has a price attached to it. That is high volatility. And let's say you did not go to the extreme by investing in a single stock, but you invested in the S&P 500. You will still have to endure about 13 years in total when your investment was down 20% from the high point and face about 8 months when it was down 50%. That is hard. So stock market investing is a great wealth creation machine, unlike any other wealth building machine. But don't be under any illusion. It does not come cheap. There is a price to pay, and the price is volatility and uncertainty. All investors will experience volatility, and you have to accept this. It is the price you pay for a comfortable future. Lesson number 2. Know what is enough. The urge to do well for ourselves and desire to surpass our neighbors, contemporaries, and friends can help motivate us to work harder and to strive to make it. Being motivated to become more productive and doing meaningful work is a good thing. But social comparison can also cause us to feel like we don't have enough. We must decide what is enough for us to be financially independent, and this should not be in comparison to others, because if you are swimming in deep waters, there will always be bigger fish. The type of envy which has emerged from comparisons of this kind has caused a lot of people to do unthinkable things or take unnecessary risks and do foolish things throughout history. Some have leveraged their portfolio to the hilt in order to move up the pecking order, only to lose it all. A famous trader, Jesse Livermore, committed suicide after losing his massive fortune, while another well-known CEO acted on insider information and ended up in jail for insider trading, losing his fortune, freedom, and personal reputation in the process. Many others have forsaken their families and lost what really matters most. As you walk towards financial freedom, at some point in your journey, you must accept that enough is enough. You must not trade something that you have and need for something that you don't have and don't need. Lesson number 3. Understand the difference between getting wealthy and staying wealthy. The skills necessary for getting wealthy are different from the skills for staying wealthy, and the investment strategies for both are different. There are 1,001 ways to make money and get wealthy, but if history has taught us anything, there are far fewer ways to stay wealthy. It almost always requires some combination of humility, in the sense that you realize some part of your success came down to good fortune or chance. So it would probably be unwise to think that you could perpetually sustain your success by continuing to take the same level of risk you did to initially get it. Frugality and a healthy dose of short-term paranoia, as illustrated by the stories of modern-day investors like Warren Buffett and investors like Jesse Livermore. The most important and often overlooked key to success as an investor is not magnitude or the size of your profits or returns, but longevity and consistency, or time you spend in the market. According to Morgan Housel, roughly $81.5 billion of Warren Buffett's estimated $84.5 billion net worth was earned after Warren Buffett's 65th birthday. Jesse Livermore was one of the greatest stock market traders of his day, amassing a personal net worth of $100 million, which is over $1.6 billion in today's money. Livermore was one of the richest people in the world and told his wife they could do whatever they wanted financially, or so he thought. Overflowing with confidence, Livermore continued to leverage his investments with huge amounts of debt. In the following years, he took larger and larger amounts of debt and risk as time went on, partly due to his risky approach and also partly due to rules that forced him to change his trading strategies. He eventually ended up way in over his head before declaring bankruptcy in 1934. This was the third bankruptcy he had filed in his life. He had assets of $84,000 and debts of $2.5 million. The moral: recognize the importance of patience, become financially unbreakable, and know what to do when things don't go according to plan. Because if you can do that, you most certainly earn the best returns. Maybe not spectacular returns in the short term, but in totality, over the long run, that's what really matters. So pick an approach that will work well for you, such as indexing. In other words, play the long game. Lesson number 4. Nobody is financially crazy. There is a reason for crazy behavior. At first glance, it seems like a lot of people do crazy things with their money, but everything is justifiable, though not necessarily wise. Some people buy things like boats, airplanes at astronomical prices. Some hide their money under their mattresses. Others from certain countries spray money at parties, while others spend theirs on the lottery. All crazy stuff, you will agree. However, the thing to bear in mind is that people come from different backgrounds and had different childhoods, different parents, different life experiences, different beliefs, different educations. All this adds up to different perspectives, beliefs, and values. What seems crazy to you might be perfectly logical and make sense to me. Morgan Housel uses the example of lottery tickets in this book. It was found that the lowest income households in the US spend more than $400 per year on the lottery. This is 4 times more than the average spent on the lottery by the highest income group. When you consider this with the fact that more than a third of Americans cannot come up with $400 for an emergency, this seems crazy, but we do not know why they do what they do. If you try to see things from their perspectives, most low-income earners mostly live paycheck to paycheck with little or no room to save money. They often lack education and therefore little chance of career advancement. They cannot afford a nice vacation or a nice car and cannot put their children through college without a mountain of debt. Therefore, buying a lottery ticket is their way of buying into the American dream that the wealthier enjoy. That is why they buy more lottery tickets than the wealthy. So how does this make you a better investor? Good question. By understanding that we are different, you become less tempted to copy others' investment strategy, which might not suit your goals. For example, your risk profile might be higher than that of millionaires because your focus is more on getting rich, while the millionaire's investment strategy is on staying rich. Copying a millionaire's portfolio might not help you realize your goals. Acknowledging differences and different perspectives can also help us to say no to investments that are outside our circle of competence or that we are not familiar with. Lesson number 5. Be prepared. What do the Great Depression, World War II, the financial crisis of 2008, and COVID-19 pandemic have in common? They were all events which hugely shaped our society and had tremendous impact on financial markets, and they were pretty much impossible to predict. These events are outliers, black swans. Nothing in past history can convincingly point to the possibility of these events. These extreme events are only explainable after the event. Human nature fools us into believing that we can predict or foresee the future. This is impossible without divine revelation. Here is an interesting fact. If you had invested in the S&P 500 20 years ago, but missed out on the 4 best performing stock market days, your returns would have been 164% instead of 291% returns. The lesson here is that it is more useful to prepare yourself both mentally and financially for a disaster which you cannot foresee than hoping that you are able to react before everyone else. Stop listening to macro projections. Just be prepared. Lesson number 6. Have a margin of safety in your investments. Having a margin of error is important, and being flexible financially is very important. The reason for this is simple. We live in a world of uncertainty and chance. Therefore, surprises for better or for worse are inevitable. Investing and financial history can be very useful in understanding of broad trends such as how people respond to fear and greed and the pressure of changing economic and market conditions. But it tends to be a poor predictor of future trends such as the moves of an individual stock or even sector of the market, because things change all the time due to the outlier events like the pandemic, the financial crisis, the Great Depression. These events are unprecedented, but someday it is possible to have worse events. It is also possible to have an unprecedented positive event. This is why when you plan, you need to plan on your plan not going according to plan. In other words, giving yourself some margin for error. One of the ways you can do this is by making sure your bets are well diversified, always keeping a healthy emergency fund and ensuring, at least to the best of your ability, that you always have some flexibility in your plan. Building this kind of flexibility into your plan gives you freedom. That is the ability to do what you want, when you want, with whom you want, for as long as you want. Lesson 7. Avoid pessimism. If I give you several reasons why the market will crash this year, government debt, supply chains bottleneck, interest rates, inflation, a new strain of COVID-19, you get the drift. Chances are that you'll be intrigued and you'll end up with a negative view of where we are in the current market cycle. On the other hand, if you are told that things will continue to get better because life expectancy is rising, sustainable energy is getting cheaper, and we have a new financially astute prime minister, and computing power is exploding, a new powerful vaccine has been discovered, you will probably just nod your head and shrug your shoulders. Isn't it strange that it is the pessimist that sounds intelligent while the optimist sounds naive in comparison? Why is this so? It has been explained that a tendency towards loss and being pessimistic is an evolutionary trait or instinct. When losses and gains are compared, it is losses that loom larger than gains. Organisms that treat threats as more urgent than opportunities have a better chance to survive and reproduce. We tend to listen more to pessimists also because progress happens much slower than setbacks do. Progress rarely happens overnight, but setbacks can happen suddenly. Therefore, it is easier to create an intriguing and persuasive story around it, and therefore it receives more attention. Bad news sells more. To create an optimistic story about the future, we need to look further down history. Only when we view history in the long term does an optimistic picture emerge. The optimistic picture is less dramatic. Knowing this can help you become less predisposed to pessimism and to believe that the world is better than you think. And here is a summary of the book. So you are not going to get rich in the stock market without paying the price for volatility and uncertainty. Envy is the worst of the 7 deadly sins. Comparison is a killer. Never risk what you have and need for what you don't have and don't need. Different perspectives cause different courses of action to be reasonable or rational. Instead of predicting and foreseeing disasters, prepare yourself mentally and financially so that you can survive them if they happen, and be careful when taking investment advice. Understand that pessimism appeals more to our survival instincts than optimism. How you behave is more important than what you know or who you know when it comes to achieving and sustaining financial success. Finally, focus on what is most important. You can be hugely successful in investing so long as you get the big things right. Don't focus on individual companies, focus on the whole market. This will guarantee that at least your money will be invested in the biggest winners, because picking individual stocks do poorly in the long run. And because you've stayed with me till the end, here are some more bonus lessons. Save as much as you can, because building wealth has little to do with your income or investment returns and lots to do with your saving rate. Saving is not just income minus expenses, but saving is income minus ego. If you honestly look at your expenses, how much of it is necessary and how much of it is based on ego? Having a high savings rate and keeping your expenses really low gives you a lot of freedom in life. So keep your expenses as low as possible and keep your savings rate, that is the percentage of your income that you save. This will give you a life of freedom quicker than most people. Freedom to do what you want with who you want for as long as you want. Money's greatest intrinsic value, and this cannot be overstated, It's its ability to give you control over your time. Using your money to buy time and options has a lifestyle benefit few luxury goods can compete with. So don't be a flashy twat. You might think you want an expensive car, a fancy watch, a huge house, but I'm telling you, you don't. What you really want is respect and admiration from other people, and you think that having expensive stuff will bring you that respect. It usually doesn't, because what you buy is not a true measure of your wealth. The true measure of your wealth is what you have not spent. And that is my 20 minutes book review of The Psychology of Money by Morgan Housel. Please like, share, and subscribe if you haven't done so already. Speak to you on the next video. Bye.